So today we're going to talk about where to park your cash and discover two little known places to get better returns. So welcome to Ironton, and you're going to learn a little bit about our formula to diversify your portfolio for maximum returns in any market condition. So grab a pen and paper. You're going to want to write down a couple ideas. We're going to pull back the curtain and show you how to make your investing a little bit easier. So have you ever wondered what it would be like to wake up in the morning with all the time that you need to do what you want to do versus all the things that you have to do because your investments are now on autopilot and they don't take a lot of work? Would you like me to share how you can get more diversified within your portfolio with less work? You're about to discover how to get higher returns while managing your risk. Well, that's what I've been hearing from you, and that's what we've developed. That's what we have for you today. So I promise that by the end of our time together today, you'll know everything that you need to know about passive investing so you can work smarter and not harder. So the problem is too many investors are making decisions based on what they hear on CNBC or the coffee shop, and they're not aware of the cycles of real estate investing or the trends across the nation, let alone locally. It's not your fault. After putting long hours in on their career and business, very few professionals have the time to do a deep dive every day into the numbers and the trends. So as you listen to me, know my intention is to help you fix that problem. The more you listen, the more you're going to learn how to make decisions based on hard data and not gossip. And the fact that you're here is that you're getting ready to make that shift to take some action now. So, what's passive investing? It's simply a way to take yourself away from managing contractors and renters and depositing checks or not getting the checks, having to hunt them down based on my over 20 years of real estate knowledge. And knowledge is power. So, that's what I want for you is the power to act. Does that make sense? So, the time to grasp that power is now. And the time is now because the markets are changing. And if you're not ahead of the trends, you're going to be left behind. And the time is now because investments don't waste for any investor. And you've got to manage your risk. So notice something. We're going to go through a lot of hard data and case studies today, and none of it is to be interpreted as any sort of type of income claim, implied or otherwise. So you'll have some confidential information we'll be presenting. Investing involves a high degree of risk. Nothing in today's presentation would be considered an investment opportunity. If you're actually curious to learn more about any of these as investments, we can get the actual formal legal documents out to you so you and your financial advisor, attorney, and CPA can help you read through them. There'll be some forward-looking statements, and those are largely sourced from company sourced information or our analysis of the market. So just make sure that you take the time to do your own research on the things that we discussed today. So in short, your results are up to you. I can't predict them. So anybody says they can predict what's going to happen in the market is usually lying to you. I don't know your assets, your chosen market, or your target goal. But I can show you how we analyze the numbers and how well that's working for myself. Does that make sense? So if you don't know the team, let me just tell you very briefly. We've got Brent Geyer, who's been in acquisition for 25 years in real estate. Richard Landry, who is the chief investment officer of a $2 billion family office, a lot of which focused on multifamily. And I've been working in the investment space for well over 20 years, and I ran a pretty large brokerage for most of that time. So the fastest and most predictable path to financial security and growth is passive investing. If you can put your investments on autopilot, then you're on your way. You're on your way to just where you want to have true freedom, especially if you can do that in a relatively short and reasonable amount of time. And I believe that's what all of us want, the freedom to experience life to the fullest while we're still hearty and healthy enough to enjoy it. And ultimately, that's what this training is really all about. Just consider for a moment how good you're going to feel when you can stop trading hours for dollars and actually enjoy your travel or hobbies or philanthropy. So our ultimate mission today is to help you be able to do that quickly and consistently. And because knowledge is power to do that, I'm going to dive in. So there are some challenges. There's a lot of information out there. It's hard to sort through it all and find the lucrative patterns. We want to add more investments to our portfolios, but there's only so many assets that we can manage. We think that our portfolios have to be bigger before we can participate in commercial grade. So you've educated yourself as much as you can, and you've acquired assets, and they're eating up more of your time until it feels like you've got another full-time job just managing your portfolio. You're hoping to get to a tipping point so you can retire, but it's getting harder because you don't have a simple, proven process. And that actually wasn't really available until now, but now we've got a lot of options for you. So when you leave the heavy lifting to the experts, you'll immediately notice how much happier you are and how much easier it is to build a legacy. So the two things we'll talk about today are the short-term income fund and the medium-term income fund. And then if you're ever curious, we've got some other funds that are longer term in nature. So why do we do it? There's a bigger reason, making the world a better place for my children, your children, and grandkids for generations to come. That's my why. So what's different about the way we do investing? Well, you've done the work. You've done a lot of work on your real estate portfolio, and so have I. And what's the difference? So passive investing. Imagine and picture a simple investing system that allows you access to high-grade investments passively. No more drumming up funding and managing contractors. A simple proven system that's the backbone of your real estate portfolio. Imagine continuously you're feeling the weight lifting off you and you're getting lighter as you move from active to passive investing. So give yourself the opportunity to relax and leave finding and managing the work to the experts. So some myths. Lucrative investments are all around us, but there's some common myths that I hear every day. If you can't write $1 million check, then you can't get access to the good deals. If you're not a multimillionaire, it takes years and years to get diversified. Well, I want to pull back the curtain and actually show you how this actually works. So I'm going to give this to Nick, who's going to explain all the details to you.
Yeah, excellent. Thanks, Lon. So where to park your cash? So to really kick off the rest of this presentation here, we're going to dive into two options here. So we've got a short-term option and we've got a medium-term option. But before getting into it, right now, with where the rates are, we've been in a persistently high interest rate environment from 2022 to where we're at today. We've seen a rise of higher interest rates on money market funds, high yield savings accounts, which has been pretty typical as the Fed has continued to raise their benchmark rate. So as a result, this is what we've seen. So right now we have many options, right? So for some risk-free opportunities, that is FDIC insured. We've got many options as presented here on this slide. So this is a great way to park some cash in the short term, especially if you need rapid liquidity, typically something 3 months or less. This would be a good storage for that kind of capital. So some of the rates that we're seeing in today's marketplace, anywhere from about a 4% to about 5.15% APY. So these are a lot. I believe these are recent, actually, as of, you just looked this up a couple of days ago, right? So these are very recent. Yeah. This isn't old data. Yeah.
Yeah, this chart says November 1st, but I actually just looked them all up yesterday as I was finalizing the presentation. They're all within 0.1%, so they haven't really changed very much.
So it's pretty remarkable. I mean, this is risk-free return on your liquid capital at the bank. So it's been a while since we've seen rates like this, but truthfully, there are better options. So to kick it off here, we've got a short-term income fund. So this is a great storage for your capital. Maybe it's 6 months or more. I typically tell investors that, look, if you need to access this money fairly quickly, if you've got at least a 9-month time horizon, short-term income fund is a great option for you. So this fund is going to be diversified across commercial lender, about 80% allocation in the real estate side of things, 20% toward our medical receivables portfolio. It returns about 8 to 9% a year. We've actually been averaging between 8.5% and 9.5%. We're paying out dividends quarterly. So with that annualized return divided by 4 is about the check that you'll get. Now, the key thing is it's not as predictable. We have been averaging returns in the 8.5% to 9.5% range. However, due to just the it's the status of the real estate market in the commercial lending side of things, there's typically lower seasons of performance and higher seasons of performance. The latter being usually around late spring to fall, and the former being usually around the colder months. Obviously, that just is because you've got borrowing demand picks back up in the nicer months as demand for buying picks back up as well. So it's not as consistent between 8.5% to 9.5% annualized return, but we do average within that range. Just know that it can vary depending on the seasons of the year. The advantage to being in the short-term income fund, obviously, as I mentioned, the liquidity. We usually just ask investors, hey, give us a 30 days notice if you need your capital out, and we can get that money out relatively quickly. Another advantage here is a tax-efficient income vehicle. So the real estate side of this is taxed as a real estate investment trust designation, which means it's going to be taxed at about the 20% federal level. So your after-tax return might be a little bit more advantageous simply because of the favorable tax treatment of the short-term income fund. So we did a pretty simple 10-year analysis here. So what we did was we took a look at pre-tax return across both options. So you've got about 3% in the money market, high yield savings on average. You've got about 8% in the short-term income fund. We have the marginal income tax broken down there. From an after-tax standpoint, we get down to about 1.83%. From the money market and high yield savings. And on the short-term income fund, it goes from about 8 to 6.1% after tax return. And what we're showing here is the comparison of both options starting at $100,000 and where you end up each year over a 10-year time horizon. So from an after-tax standpoint, you can see there's clearly a $61,000, almost $62,000 advantage here to being in a short-term income fund relative to a money market and high yield savings. Now, one key thing here is we are assuming that 3% pre-tax return does not change. So as you all know, in 5 years, if we're in a much more favorable lending environment, if the Fed decides to lower rates much lower to where they're at now, overall that 3% pre-tax return can go down. Banks will be unwilling to lend at the risk-free high rate that they're at now. So in reality, that number could be much less over a 10-year time horizon. But we're going to, do you guys a favor here and show you and assume that we're going to hit a 3% pre-tax return every year on the left-hand side.
It's a big difference, $62,000.
Yeah, huge difference. Absolutely. And that's after tax too. So not pre-tax. That's a key thing to look at. Here are some updates on current year, 1 year CD. So a lot of our investors have taken advantage of this product. Again, another risk-free way of earning a relatively high yield historically on risk-free cash that's FDIC insured. So you can see the 4 different options here. Synchrony, Sallie Mae are paying around some of the highest on CDs. Now your money's locked up for a year. You can't get that money out. That's very important unless you want to pay a penalty or give up most of the interest that you've earned in that time horizon. But Synchrony and Sallie Mae here as these 2 examples. There's many other examples out there. They'll pay about up to 4.2% on a 1-year term certificate deposit. And again, those will oscillate as the interest rate environment changes over time.
Hey, Kevin had a question about the minimum amount of time for investing on the short-term income fund versus the medium. Maybe you could provide a little insight on how the lockups work.
Yeah, absolutely. Good question. So no lockup on the short-term income fund. Typically investors will be in that fund for a year. If you wish to exit in under a year, there is a 1% redemption charge back. That's why I tell investors have at least a 9-month time horizon here. If you're looking at using that for 3 months, you're better off actually being in a money market or a high yield savings account where it's immediately liquid. So you're better off being there. So I usually say short-term income fund, 9 months or more, but there's no required lockup period. So that's important to distinguish from the medium-term income fund. There is a required 1-year lockup on the midterm fund. So you can't get the money out until that 1-year lockup is up. And then you can request a portion or all of your money back at any point after.
Perfect.
Yep. So just discussed the short-term income fund. We've got a medium-term income fund that I already introduced us to. So the midterm fund returns between 11 and 13% a year, pays quarterly dividends. That 11 to 13% is fixed, and it depends on your assets under management across all of Ironton Capital's funds. So right in the middle, you've got 12%. So if you're at 500,000 in AUM to 999,000 in AUM with Ironton, you'll get 12%. And then it decreases and increases from there, just depending on how much you have invested with us. So there is some liquidity. We do ask for a longer lead time. This one, it can take much longer than 30 days to get your money back. Usually between 2 and 3 months liquidity or advance notice is what we ask for so that we can ensure we get your money back in time. And you do have to wait for that 1 year lockup to end before you can request redemption of a portion or all of your capital. Now, the one key advantage here with the midterm fund, everybody that's on this webinar, you guys know what's going on. The real estate market has gone through a major shift over the last 3 years. Interest rates have remained persistently high. I think that's likely to stay through 2025. We might see a little bit of relief in 26. The stock market, as a result of these tariffs that have been put in place, has really caused a significant disruption in the stock market. So what's beautiful about the midterm fund is there is no correlation to what's going on in real estate. There's no correlation to what's going on in the stock market. This is our medical receivables portfolio. So you're getting a fixed annualized return that pays quarterly with no market exposure. That's a really important thing to consider here with the midterm fund. So while the short-term fund, there's some variability in performance due to the commercial lending aspect of the portfolio, the midterm fund, which is 100% receivables, medical receivables, there's no correlation to market fluctuations. And so that's a key thing here. So despite all the fluctuations that have been happening, the returns to our limited partners have not adjusted or changed upward or downward. They've been remaining very consistent. And this fund is diversified across a portfolio of over 25,000 individual medical invoices. Anything to add there, Lon?
That's really it. I think, the way I try to explain this to people is that we're usually lending about 30% of the value of the invoice. So if the medical claim is $30,000, we'll give $10,000 to the doctor or the clinic. And we like to work with high volume doctors who've got at least a basket of 100 different claims with different insurance companies. And then what we might do is advance on about 90% of the claims. So they're all cross collateralized. So if you're involved in real estate, the easy way to think about this is if you had 100 rental properties that were completely paid off and you came to us as a bank and we offered you mortgages on the same terms as we do on our medium-term income fund, we would pick 90 of your properties, give you a 35% loan-to-value loan. 10 properties, we wouldn't give you any money, but we would still put a mortgage against all 100. And if you defaulted on any one of those 90 properties, we'd have the choice of any of the other 99 we could go after. We could pick as many as we wanted to go after to get paid back. So nothing is ever foolproof, but this is pretty well thought out.
Yeah, it's a really good point to mention. So you've got strong diversification and you also have downside protection in the event something wrong were to happen. So that's a key thing here too.
And we're collecting from the insurance company, not from the patient. So, you don't have the credit risk. Like, State Farm is going to be able to pay the claim. And we only do the smaller claims. We don't do $500,000 claims. We do $30,000 claims because there's a lot less arguing about a small claim.
Mm-hmm. Awesome. So really wanted to get into a pretty cool case study that I did here recently. So we had an investor here in Denver. He's got about 8 rental properties. 4 of them are free and clear. The other ones have leverage on them. And he came to us and said, look, I'm looking to shake things up a little bit. I'm looking at the returns over my portfolio. I'm seeing how the trends are moving in Denver from being more of what it once was more of a balanced or tenant or landlord friendly state to more of a tenant friendly state. So he's really just looking to reposition some of his portfolio, capture higher income and higher growth of his overall portfolio. So he's not as focused on growth. He's primarily focused on income because he came to us and said, look, I need to live off this income. That's my goal. So my goal here is to increase my income, live off more income and do more. And so he came to us wanting to take a look at 4 debt-free properties and what the numbers would look like if we refinanced those 4 debt-free properties. And then he had a negative cash flowing property that's just sucking the money out of his bank. He's continuing to have to inject cash into the property. And we found that there was considerable changes that we can make that would significantly benefit him. So looking here, this is a pretty typical analysis we do with investors. So investors come to us and they say, here's my purchase price, here's the debt, here's my annual income, the appreciation that I'd like to input into the model. And we also ask for what their buy and repair. So what improvements have been made, what their purchase date was, so we know how many years have been owned, and what that depreciation that was likely taken on the property. And so we run all of this through our model, and we look at it in several different ways. So we want to show investors a comparison. Look, if you did nothing with your property over the 5 to 10 year time horizon, where would your wealth be? How much accumulation would you get? So in the case of this guy's rental property, he's getting negative 346 a year in cash flow. We did go on the higher side. He's estimating that we'll see 7% appreciation in the Denver area. I think it's likely to probably be around 3 to 4%. But I wanted to be, I wanted to be a little bit aggressive on the appreciation to see how that would compare to some of the other numbers. So right now he's getting about an annualized 11% return. So that is a combination of the appreciation and equity growth and the cash flow on the property. So about $34,000 a year he's getting on this property. Now, if he were to sell today, he's going to incur sale costs. He's a realtor, so he's going to sell his property. He's not going to turn it over to another broker. If the latter, we would typically estimate about 6 to 6.5%. But in this case, we're going to estimate 3.5% in sales costs, which is commissions, title fees, inspections, etc. So property value is about $491,000. Once the debt's paid off, about $181,000 in debt. He'll have an equity before sales cost amount of about $309,000. When we deduct sales costs, we get to about $292,000. Now, one option he has, if he's growth oriented and he doesn't need income today, is to go into the National Diversified Fund. We have 2 share classes. One of those share classes, we're concentrating all of the depreciation and passive loss from the investments directly to the investors who really need it. This is an investor who would really need it. So if he wanted to go into the NDF and put all this money into the growth fund, I'm going to draw your attention to the left-hand side here. We usually estimate we can get between 10 and 30% of an investor's amount in depreciation. I split the difference and we did 20%. So equity that can be invested. So we took the equity after sales cost of $292,000 and we deducted the estimated depreciation benefit of about $58,000. And so you can see here that we've been able, on the very last row on the left-hand side, we're able to defer about $14,000 in overall. So that's about $14,000 in overall cap gains tax deferred as a result of investing in the National Diversified Fund. And so we took that amount, the leftover amount, and I'm going to go back to the slide I just passed through. And the amount he has left to invest, taking the equity from the old rental transaction, or subtracting the transaction cost, and then subtracting the capital gains tax. Again, there's a difference between, if you look at the cap gains tax row, we go from $71,000 to about $57,000. That is due to the depreciation benefit that an investor will get by going into the National Diversified Fund. So we're starting off at a little bit higher of an investment amount there, so about a $14,000 difference. Now, when we compare the do nothing scenario, we're at about 11%. So over 5 to 10 years, if they did nothing and they kept the property and they continued to earn 11%, they'd be at about $521,000 in total equity in year 5. And at the end of year 10, about $878,000 in total equity. So 11% return is actually one of the better returns I've seen, projected returns I've seen on rental properties. I usually see much lower than that, especially for investors who have a lot of equity buildup. They haven't been able to increase their rents as much in that same time period. Meanwhile, the debt has continued to gone down. So the leverage has really decreased tremendously, which causes a much lower return on equity. But in this investor's case, he's getting about double-digit return on equity, which is pretty strong. Now, if I turn your eyes to the left here, if we look at the National Diversified Fund, we're targeting about anywhere from 16 to 20% in the National Diversified Fund. So if he sold the property today and reinvested the $234,000 at 17% compounded a year, at the end of year 5, he's about $6,000 or $7,000 less in overall equity growth relative to the do nothing scenario. But it really starts to take off in years 6 through 10. So you can see it grows to about projected 1.13 million in overall equity growth relative to the 878,000. So about a $240,000 difference in overall wealth accumulation by selling today and investing in the National Diversified Fund. Now, in the midterm fund, the investor pays the transaction costs, pays the cap gains tax, has a little bit lower an amount to invest because he's not taking depreciation. So he's starting off at a lower amount of $220,000. Now, if he invests in the midterm fund, we're assuming here that he's reinvesting all of his dividends and he's not taking any income. We just want to make sure we're showing an apples to apples comparison here of the compounded growth of the equity. In the end of year 5, he's at about $388,000. At the end of year 10, he's at about $684,000. So in this scenario, it's actually much better. If you're a growth-oriented person, you don't need the income to live on. Maybe you're a high-income earner. You just have income from other sources coming in. You just want to focus on equity growth over a decade. It's actually better for him to do nothing in this scenario. And then on the stock market side, he's going to deal with a lot more volatility. And that's actually the worst scenario of the 4. So I would recommend he wouldn't do that. It would be a good idea to go into the NDF, just due to the overall wealth accumulation. However, and I'm going to go back a slide, this investor's goal is income. So he told me, he said, look, I don't need growth. Like I said, I need income. I want more of it. This is what I'm living on. So let's not even talk about the National Diversified Fund. So we ran the analysis through more of a hybrid investment strategy. In this case, we're putting everything into MTI. So he's going to take the $220,000 that he has left to invest. And again, in the middle column here, I show you what it looks like compounded, where all the dividends are reinvested. But in reality, he wants to take the income. So he's not going to reinvest those dividends. So what does he get? He gets about $26,460 in annual passive income. Every quarter, he'll get a check of just over $6,600. So on the left-hand side, you'll see the investor AUM and MTI returns here. So I simply just took 220,000, multiplied that by 12%, and then divided that by 4 to get the quarterly cash flow. So this is a tremendous improvement from his previous scenario. Remember, he was getting negative $346 in annual cash flow. So he was injecting money into the property. He was not getting any return except for the appreciation of the property, but that wasn't doing him any favors as far as putting more money in his pocket and giving him more money to live on. So he can sell today and turn a negative $346 a year cash flowing property into $26,460 in annual passive income. He doesn't have to manage tenants. He doesn't have to manage contractors. He doesn't have to deal with the property management. He can simply sell the property, reinvest with us, collect his quarterly checks, and eliminate the headache of managing that rental property. So these are situations that we are discussing with investors every single day. This is a very real scenario. And we sent this to the investor, and it's likely that he will move forward. We're able to give him another $6,600 a quarter in additional income just on this one property and by selling this property. So he's got 4 other properties, moving on to the debt-free properties. So here are 4 properties that, again, have no debt. So if you look on the left-hand side under property information, we've got a property value of about $530,000. Again, we're estimating 7% annual appreciation. His annual net operating income, which is his cash flow, there's no debt service, so this is his cash flow, is about $19,500. So over 5 years, he's getting about $97,000. His marginal tax rate's about 24%, and his monthly cash flow is about $1,600. So not bad. It's a debt-free property. The only thing he has to worry about is potentially rising expenses such as insurance costs and taxes. That'll eat into his cash flow if he doesn't increase his rent in that same time period. So there's still other risk factors here, but nonetheless, he's getting $1,600 a month in free cash flow from this rental property. Now, he's got so much equity trapped, he can actually tap into this and take advantage of some of that equity and still maintain some positive cash flow on the rental. So we're assuming that he's going to cash out at about 75% loan to value here. So you can see his new loan amount and the estimated closing costs. We're assuming about a 7.25% interest rate. We have this spreadsheet, so we're happy to run numbers on your individual rental properties. The yellow cells here are manual inputs, so we can change that. So interest rates we're seeing on rental properties, I'd say, Lon, probably between 7 and 7.25. Right.
Yeah.
Okay. So if I direct your eyes further down here, how much do you want to invest in Ironton? So I brought it down to a point where we could ensure that he's still close to break-even cash flow in his rental property. He doesn't have to put any more money into the property, but he can still maintain, some cash flow. So over 5 years on his rental property that's now been refinanced, over 5 years, he's getting about $853 in cash flow and about $244,000 in overall monetary benefit from appreciation, principal reduction, and depreciation. So he could cash out. He can actually cash out about $385,000 on a 75% loan to value property. Let's just say he wants to take $230,000 because he still wants to maintain positive cash flow of the rental. He can take $230,000, invest in the midterm fund at 12%, and over 5 years, he's going to get $138,000 in passive income. That comes to about $27,600 a year in passive income. He could also look at the long-term fund. His net gain will be approximately projected to be about $296,000. So his projected ROI on the far right side, if he invests, does the cash out refi, and he invests in the midterm fund, because again, income is his priority, not growth. So let's just stay focused on the midterm fund. His projected ROI pre-tax goes from up top, we see 12.4% that he's earning on the rental property by itself. If he does a refi and invests $230,000 with us in the midterm fund, he gets about a 2% increase in overall return pre-tax. So about a 200 basis point swing by making a pretty simple maneuver. So pretty attractive there. And when we get to the end, I'll tell you, I'll illustrate the math of the additional income that he'll get. So property number 2, current equity, it's about $561,000. He's getting about $18,000 a year in cash flow, $1,500 a month. Again, a 7.25% interest rate. He's going to take, the max available he has to withdraw on a cash out is about $408,000. He's going to invest about half that. So he's going to put about $210,000 to maintain positive cash flow on the rental property by itself. He's going to invest the $210,000. His pre-tax ROI, pretty similar to the previous property. He's going to go from about 12% to 13.7%. And now he's going to earn about $25,200 in overall annual passive income from the midterm fund.
That's pretty good.
Yeah. So property number 3, very similar scenario. We're going to say that he's going to invest about $160,000 from his cash out refi up to 75% loan to value. So he'll have $160,000. If he invests that in the midterm fund, his net gain over 5 years will be about $96,000. He'll get about $19,200 in annual passive income. And his ROI, again, is about a 200 basis point spread going from 12.5% to 14.5% over 5 years pre-tax. And the last property here. So we've got a $473,000 property. He's going to do a cash out refi. We're going to make sure that he maintains close to break even cash flow on the 75% loan to value cash out refi. We're going to invest $180,000 in the midterm fund. His net gain from the midterm fund over 5 years is going to be about $108,000. So his overall return pre-tax by doing the cash out refi and investing with us goes from 12% to 13.8%. So I'm going to backtrack a few slides here. Excuse me. So on the first property, as I mentioned, his cash flow improves to $27,600. So we're taking him from about $19,500 to $27,600 in passive income by doing this cash out refi. On the second property, we're improving by another $7,000. So we're going from $18,015 to $25,200. On the third property, we're improving his cash flow from $13,890 to $19,200. And on the fourth property, we're improving from $15,260 in cash flow annualized to $21,600. So when you add all this up, you get about $120,060 in passive income, which represents over a $52,000 a year increase in annual income. So every month, he's going to earn pre-tax an additional $4,400 by selling the property with the negative cash flow and refinancing the debt-free properties. Now, he's got some leftover cash to invest, right? Because we showed you that he's got the max available to withdraw, which again, for this example, the max available he can withdraw is $344,000, but we're only going to invest $108,000 so that we can maintain positive cash flow in the rental property. So he still has, across all scenarios, about $627,000 that he can invest in the National Diversified Fund. He'll be locking capital up for about 4 to 6 years, but generating higher returns in the 17 to 20% range. So we're able to accomplish many goals for this investors. One, we're able to eliminate the eventual headaches that he might get or that he might already be experiencing by being a landlord, managing his rental properties. One thing that's certain to happen is that his taxes will go up on his rental properties. His expenses will likely go up. Those always go up. His management fee could go up if he's paying a management fee, or maybe he's self-managing it himself. So there is a lot of exposure to potentially less cash flow on the refinance properties. But we're able to offset that by going through the refi and giving him more passive income in the midterm fund. So we're eliminating just the active man. We're eliminating, the more of that risk exposure to expense increases, because now we're giving him more passive income to be able to offset and also just to live on. We're giving him about $52,000 or more a year in additional passive income with zero headaches. So again, $4,400 per month. That's pre-tax income. So we're not looking at this post-tax. Everybody's tax situation is different. And then he also has more than $500,000 left over if he wants to. Maybe he wants to pursue his own passion project, or maybe he wants to redeploy those funds into the National Diversified Fund to capture higher returns over a little bit longer of a time period. So at the end of the day, this investor is very pleased. He's looking at these scenarios. He's likely going to take some action. We're able to get him $52,000 more a year in cash flow, and that's a huge win for him. And so these are conversations we're having every day. These are case studies that are, we've got many more of these. And so it's really exciting to be able to help an investor out like this in so many ways. Lon, do you have anything you wanted to add to that? Any commentary?
No, that was fantastic. And I've been answering questions as they popped up in the chat box. I think we're pretty current on all that too. But
awesome.
For those of you, if you haven't noticed, there's a chat window on the right-hand side. So if you want to type in a question, we'll try to answer it for you.
Awesome. Thanks so much. So just a recap of the two income funds here. We got the short-term and short-term income fund 1 and 2. They're the same fund. They've just been running for 3 years. So we opened up another fund because we surpassed our SEC number of investors requirement. So again, both funds, current IRR is actually about 8 to 9. We've actually been seeing 8.5 to 9.5%. And then the midterm fund, again, right down the middle, you got about 12%, but that's dependent on your assets under management. All right. Just some quick testimonials here. So John S., he's moved a lot of his money. He had a lot of stock market exposure, and some of the recent economic factors were impacting the valuation of his account. So he's been able to move some funds over to the income fund. He's also referred a number of friends and family. Jared here, in the last 15 months, he's had 4 properties. Those tenants decided to not renew their lease. So he decided to become more passive, sell those rental properties and invest passively. And ultimately, he's been able to buy a lot of his time back. Again, very similar situation to the previous investor in the case study I just reviewed. We're able to bring him more passive income than he was getting on his cash flowing rental properties. And he now has more money to spend, go on a family vacation. He has a lot more freedom and flexibility, which is ultimately what we're buying here, is freedom and flexibility. Same thing with Justin. Justin's one of our top investors. Over the last 3 years, he has been actually quickly, I was going to say slowly, but actually quickly unwinding his Georgia rental portfolio and several of his Denver assets. And he has nearly reinvested most of that income with us in both the midterm and the National Diversified Fund. All right. So,
all right.
I'll turn it over to you, Lon, if you want to close it out for us.
Yeah. So every investor isn't the same. So we've got funds for long-term growth, as well as the short and medium-term funds with liquidity that we talked about today in a lot of detail. So the longer-term funds, they don't have any liquidity, but their target return is over 16% a year. So if that's of any interest, you can let Nick know. Maybe, Nick, you could drop your contact info into the chat box there, and we could talk to you about all that. So, what are some of the, sort of features and benefits? Rapid results, because we do all the finding, touring, due diligence for you, and they'll give you more time to do what you want, when you want, with the people that matter the most. It's going to help you have more time to enjoy greater diversification across geography, asset class, strategy, and the investment is entirely and truly passive. We do all the lifting, and we provide quarterly updates, and you deposit the gains. If I did a good job, would it be okay if I share with you how you can go into deeper detail on all this? So, first, who is it not for? It's not for the people who want to do it the long, hard way, which was me when I first got started. People who want to jump in with their eyes closed. I want you to know everything that's included, and you want to talk to your financial advisor team to make sure that we're a good fit for your portfolio. So, who is this for? Accredited investors who are done dealing with renters or endless deals and are ready to leave the heavy lifting to experts. So what's an accredited investor? You just have to meet one of these criteria. If you're a single person with a household income over 200,000, if you're a dual household income over 300, or if you have investable assets, not counting your primary, of $1 million or more, any of those will work out well. How can you go about funding the investments? Well, cash. A lot of people use their self-directed IRA. You can take, if you've got a rental property with a low mortgage balance and a lot of equity, you can get a line of credit to take cash out, and I can introduce you to bankers to help you out with that. Or you could do a HELOC. There's just lots of different ways that we've seen people do it. So the general partners invest in all the funds that you're not investing by yourself. And then of the profits that we get, we've donated over $250,000 to these charities over the last 5 years. And I'm excited to give more as we succeed together. I'm on the board of directors for Boys and Girls Club, Ronald McDonald Charities, and the Denver Zoo. So they're all great properties here, or charities here in the Denver metro area. So last but not least, if you'd like to do an analysis with Nick or somebody on the team, here's what you can do. You can go to irontoncapital.com/IC analysis, like Ironton Capital Analysis, and we'll give you the numbers. So our goal of that is just to give you a really clear idea. If you do nothing, here's the wealth accumulation for your family. Or if you take advantage of a couple different opportunities, what are the pros and cons, and what does that mean for your family? And then you and your financial team and your family will have all the facts you need to make an informed business decision. And there's been situations where not doing anything was the best answer, and then people said, at least I sleep better at night having gone through the exercise to figure it out. So,
like Lon said, happy to do an analysis here. I just want to speak to one of us and ask us any questions about our funds or learn more about some of our investment opportunities. So we're always available and happy to answer your questions and be a resource for you.
Thanks, everybody. I appreciate you making the time tonight.